So what we want to do is start off by talking about asset classes and financial instruments. And what I mean by that is we're going to be looking at three different major asset classes. We're going to be looking at stocks, bonds, and then also the risk-free rate. And we're going to be seeing throughout the course how to combine position in stocks, position in bonds, and a position in the risk-free rate to form a portfolio that performs the way that we want it to. In other words, we're going to be forming portfolios that give us a high expected return for the risk we're taking on. So let's start in and take a look at the different types of asset classes we'll be considering. So let's start off by taking a look at money market instruments. Money market instruments are short maturity debt obligations. And when I mean short maturity, I mean maybe 1 month, 3 months, 6 months, 1 year, a short period of time. They're short maturity debt obligations that pay 0 coupons. So in other words, I'm going to invest a certain amount of money now. I will receive a fixed amount of money in the future, and they're used as a store of value. And what do I mean by that? Suppose a company has some cash and they don't expect to be using this cash over the next 30 days. The corporate treasurer in this company has a few options. First, they could just hold it in cash. The challenge with holding the money in cash is that there is 0 interest earned on that position. So instead, what they can do is take the money and buy a treasury bill. And we'll talk about the details of the treasury bill in just a moment. But they'll take the money, buy a treasury bill, earn some small rate of return. And so it is better than holding cash where you would earn 0 rate of return. Furthermore, these markets tend to be very liquid, very deep, which means that I can find a buyer when I want to sell the position. So for example, that corporate treasurer decides after 15 days that actually the company does need the cash. They're going to be able to go out and find a buyer for that treasury bill position relatively easily. They trade in large denominations. In fact, this is a market that's dominated by institutional investors. And when I say institutional investors, I mean professional investors at pension funds or at mutual funds or at private equity funds. Or, for example, that corporate treasurer, when they're investing, they would be in that institutional investor class. So they tend to be then large markets dominated by institutional investors, large denomination size. So, for example, in Singapore, the trading increment for SGS treasuries is $1 million. So it means I can either trade 1 million, 2 million, 3 million, so on. So very large markets. It's not for retail investors. Now, retail investors do have access to money markets, but they are going to invest in money market instruments through a mutual fund. We'll be spending one full lecture talking about mutual funds in quite a bit of detail later on in the course. In this class, we're going to be focusing primarily on one money market instrument, the treasury bill. So let's start by taking a look at U.S. Treasury bills. We'll be looking at Singapore government treasury bills in just a minute. So U.S. Treasury bills, they have maturity of less than 50 or equal to 52 weeks. So again, short maturity, useful as a store of value. Also, they're perceived to have no default risk, so that when an investor buys a treasury bill, they know that they're going to get their money in the future. Again, useful as a store of value. It doesn't pay any coupon payments before maturity, so 0 coupon. And I want to point out that the textbook talks a little bit about the tax implications of U.S. Treasury bills. And you can safely ignore this for the purpose of assessment. So we will not be going into the tax implications of U.S. Treasury bills. So U.S. Treasuries are sold at auction. So if you were an institutional investor, you might purchase the Treasury bill from your dealer who had purchased it from the U.S. Treasury at an auction. And if you're a retail investor, you might buy this online. In fact, the US government, for retail investors who maybe have $1,000 or $2,000 to invest, can access the Treasury bill market through a government website. So we're going to be using Treasury bills, whether they're in the US or in Singapore, as the risk-free rate of return. And so US Treasuries are considered safe. In other words, they're backed by the full faith and credit of the US government, and there's never been a default of a Treasury issue in history. They're not callable. Remember, a callable bond is one that the issuer can call back the bond, buy back the bond from the investor at some fixed price that's determined when the bond is issued. So these are not callable bonds. Again, they're deep liquid markets, so that an investor can buy or sell a $100 million or $200 million position in the US Treasury and Treasury bills and have little effect on the market, so that they, again, useful as a store of value. Should I want to get my money back earlier, I can sell the bonds back or the bills back into the market and know that I'm not going to really affect prices. Now let's take a look at Singapore government Treasury bills, or SGS Treasury bills. So the government of Singapore issues Treasury bills and also Treasury bonds too. We'll mention that in just a moment, on a regular basis. Actually, it's the Monetary Authority of Singapore, MAS, that issues the treasuries on behalf of the government. I want to point out that these are considered to be exceptionally low default risk securities. In fact, some of the safest from a default risk perspective in the world. And that's because the Singapore government constitutionally cannot issue debt in order to fund government operations. So what do I mean by that? In the United States, the government would issue a Treasury bill. They would take the money and they would use it to pay for the running of government operations. Now, they are going to be receiving large volumes of tax receipts, so then they use the tax receipts, the tax payments from the citizens in the United States to pay back the interest and principal on the Treasury bills or Treasury bonds. In Singapore, on the other hand, they're not allowed to do that. So they can only take the proceeds and invest the proceeds. So in essence, there's always the money there for investors to get back. So as a consequence, there's very, very low default risk. In terms of the maturity of these issues, and they will issue 3- and 1-year issues as far as Treasury bills. And in terms of Treasury bonds, issue 2, 5, 10, up to 20-year Treasury bonds. And I want to point out that those Treasury bonds are going to be paying coupon payments. In fact, we'll be talking about coupon bonds and their risk profile later on in the course in quite some detail. The market for this for SGS Treasuries it's deep, again, very active, and they're traded in the OTC market. And by the way, OTC market, over the counter market, it is in contrast to an exchange where all of the participants trade through one particular location or website or something like that. And over-the-counter market will be a series of dealers that will call up each other and trade over the phone, or they may trade directly with each other through something like Bloomberg. They, again, have large minimum trade sizes. So as I mentioned before, minimum trade size on a SGS Treasury is $1 million. So you can trade 1 million, 2 million, 3 million, etc. And dominated, again, institutional investors is a very commonly used cash management tool by both institutional investors and by corporate treasurers. The retail investors would be able to buy Treasury bills through the Singapore Stock Exchange. So they wouldn't necessarily directly participate in this over-the-counter market. Instead, they would buy it through the Singapore Stock Exchange.